Peace be upon you guys. Today we're gonna learn about completing the audit. Whenever an audit work has been done, the auditor need to undertake the overall review of the financial statements. The auditor need to decide whether to disclose or not certain matter in the financial statements. Now, the auditor must consider whether the information presented and the policies adopted are in accordance with the Companies Act 1965 and accounting standards. There are certain standards that must be followed, such as FRS 101, FRS 110, FRS 124, and FRS 137. Analytical procedures are used to confirm the conclusions made during the audit of individual account balances. The auditor usually apply it at the end of the audit when forming overall conclusions to determine if the financial statements are consistent with the auditor's knowledge of business. If there is a significant fluctuations which are inconsistent with the predicted amount, then the auditor need to investigate and obtain adequate explanation and evidence. The next topic is going concern. It is where the auditor assesses the risk of going concern problems at the planning stage and again during the final review. An entity is assumed to be able to continue as a going concern for at least the next financial year end. There are three indications that auditor need to be alert for the going problems, which are operating indications, financial indications, and other indicators. Under operating indications, the auditor need to be alert on the loss of major market or loss of management personnel. Under financial indications, the auditor need to be alert on the net current liabilities, inability to pay creditors when due, or substantial operating losses. Under other indicators, the auditor need to be alert on pending legal proceedings against the entity. The management can provide information to the auditor on how to mitigate the going concern problem, such as maintain adequate cash or receive confirmation for financial support. In terms of audit conclusion and report, if the going concern has been resolved, therefore there is no need to modify the audit report. If the going concern has a mitigating factor, then it must be disclosed in the financial statements. As notes thus, the auditor report will have unqualified report with emphasis of matter. However, if the management does not want to provide disclosure on mitigating factors, then the auditor report can be a qualified opinion if not material, or adverse opinion if material. In addition, if the going concern result is inappropriate, if it's material, then it will be adverse opinion, and if it's immaterial, then it is disqualified. Next, we proceed with post-balance sheet events, contingencies, and commitments. Under International Standard of Auditing Section 60, an auditor should consider the effect of subsequent event on the financial statement and on the auditor's report. Auditors should review the management's procedures to identify subsequent events and perform specific audit procedure to identify it. The auditor needs to ensure that subsequent events have been properly accounted for in the financial statements. There are three periods that are involved in subsequent events. The first period is from the year end, during the fieldwork but before the signing of audit report. This is where auditors have a responsibility to perform procedure to discover and evaluate all subsequent events. The second period is from the signing date to the delivery of financial statements. In this period, management have responsibility to inform auditor for any changes, and it is up to the auditor to amend it or not. The third period is after delivering the report. If there is any changes, the auditor need to discuss with the management and take appropriate action. There are two types of subsequent events, which are non-adjusting events and adjusting events. Non-adjusting events is a conditions that exist subsequent to the year end. If material, it needs to be disclosed in the notes to the accounts. For example, purchase and disposal of a major business. An adjusting event is an event that can affect the financial position at the year end. For example, the bankruptcy of a customer after the year end must be adjusted during the year. Contingent liabilities is a potential liability that may occur in the future. For example, pending court cases. In order to identify contingent liability, the auditor needs to read minutes of meetings, inquiries management and lawyer, review contracts and loan agreement, or inspect other documents. If the contingent liability is material, then it needs to be disclosed in the financial statements. In terms of litigation issue, the auditor needs to issue legal confirmation letter to request lawyers for identification of litigation case. For example, list of claims or actions against the company. Commitments is an agreement to commit the entity to a set of fixed conditions in the future regardless of what happens to the company profit. For example, long-term contractual commitments to purchase raw materials and to sell their products at a fixed price. Now, we proceed with the opening balance and comparative figures. It refers to the account balances which exist at the beginning of the period. During this stage, the auditor needs to ensure that the amount brought forward from the previous period is correct. In terms of comparative figures, the auditor must determine if the comparative figure needs to be reclassified. In order to do so, the auditor must check if the comparative comply in all material respects of the financial reporting framework. Audit of accounting estimates. The auditor needs to obtain audit evidence in regards with the accounting estimates such as depreciation rate, accrued revenue, or deferred tax. The audit procedures involved on testing the process used are testing the calculation or compare the estimate of current period to last period. In terms of review on subsequent event, the auditor can get evidence from the accounting estimate made by the management by looking at event after the year end. For example, bankrupt of a customer. Related party transactions. An auditor needs to perform audit procedures to obtain audit evidence regarding related parties transaction and its effect on the financial statements. An auditor should obtain this information from the client at the completion of audit to ensure appropriate disclosures are made in the financial statement. For example, purchase or sales of goods or leasing and rental arrangements. The auditor can review last year's working paper to identify related parties and their transactions, review minutes or confirm with the related party the term and amount of the transaction. The next topic is documents in completing the audit. The auditor needs to obtain appropriate representations from the management either orally or written. The management representation letter is a letter from the management to confirm to the auditor that all information has been properly disclosed in the financial statements. This is to ensure that management has acknowledged its responsibility for the financial statements and can be a source of audit evidence. The final topic is finalizing the audit. An overall final audit review by the audit manager and partner on the financial statement and must give a reasonable basis for an audit opinion. The auditor can also issue management letter to advise client on the weaknesses of the internal control. There are also two lists of outstanding matters that need to be issued, which are confirmations on directors' shareholding and remuneration and others outstanding matters. That's all from us. Thanks for watching.